American agriculture owns $4.54 trillion in assets, more wealth than any farming sector on the planet. And it cannot pay its bills. Since 2022, net farm income has cratered by nearly $29 billion, while total debt climbed to a record $624.7 billion. And the working capital that farmers need just to buy seed and diesel is forecast to shrink another 9.2% this year alone. Bankruptcies surged 46% in 2025. Over 160,000 farms have disappeared since 1997. None of that triggered a financial reckoning, because the land under those failing operations keeps appreciating, which means the balance sheet looks fine, even as the actual business of growing food bleeds out. $12 billion in emergency bailouts, record operating loans, and an asset base that exists almost entirely on paper. That is what holds this system together right now. And understanding exactly how fragile that arrangement has become reveals the most underreported financial crisis in America. The balance sheet mirage. Banks do not evaluate farms by their crop yields or harvest revenue. They evaluate them by assets minus liabilities. And that calculation produces a number that looks remarkably safe. $4.54 trillion in total assets against $624.7 billion in debt gives a debt-to-asset ratio of 13.74%, comfortably below the 20% threshold that triggered mass foreclosures during the 1980s. Here's the thing nobody mentions. 83% of those assets, $3.77 trillion, consist entirely of real estate, the land itself rather than anything that actually produces food. Productive assets like machinery, livestock, and stored grain fill the remaining 17%. And those non-real estate assets dropped by $15 billion heading into 2026 because farmers sold off crop and livestock inventories just to generate operating cash. 0.14. That is the asset turnover ratio for American agriculture, the lowest figure recorded in 60 years of tracking. 14 cents of production value generated for every dollar sitting on the balance sheet means this sector no longer functions primarily as a food-producing enterprise. It functions as a land-holding operation that incidentally grows crops. The income collapse. Everything that went wrong traces back to 2021 and 2022, when everything looked perfect. Pandemic supply chain chaos, the war in Ukraine, massive federal stimulus. All of it drove commodity prices to historic highs, pushing net farm income to a record $181.9 billion in 2022. Farmers expanded operations, bought new machinery, bid up land prices, and locked in expensive input contracts. What nobody accounted for was that total production costs surged by more than $100 billion between 2020 and 2023, a 28% increase. And those inflated costs became permanent fixtures in every operating budget nationwide. Commodity prices came back down. Brazil harvested record soybeans, grain flooded global markets, and revenues shrank everywhere. Costs did not follow. $477.7 billion. That is the forecast for total production expenses in 2026, stubbornly elevated and showing no signs of retreating. The USDA cost-price gap stretched to a 10-year high of 34.1 index points, with production costs climbing roughly 50% since the 2011 baseline, while prices received crawled up by only 21%. Acre by acre, the numbers expose the damage. Corn requires $467 in variable expenses per acre, and at a projected yield of 183 bushels, selling for $4.20 per bushel, gross revenue lands near $768. Layer on fixed costs, debt service, land rent, and equipment depreciation, and the operating profit margin drops to somewhere between 0 and 5%. Soybeans carry total costs approaching $678 per acre, with margins just as thin. Wheat operations face total costs near $409 against gross revenue of only $288 per acre, which means every wheat farmer in America loses money before a single government check arrives. Who gets crushed? The squeezed middle. 86 to 88% of all United States farms qualify as small family operations, generating less than $350,000 in gross cash farm income. Yet they produce only 19% of total agricultural output. Between 52 and 79% of these operations ran at high financial risk, even during the 2022 boom, posting operating profit margins below 10%. The reason they rarely default has nothing to do with farming. Median off-farm income for farm households reaches a forecast of $92,815 in 2026, which means wages, pensions, and Social Security quietly recapitalize the farm's working capital year after year. And that external income creates a legal trap that most of these families do not see coming. Chapter 12 bankruptcy exists specifically to let family farmers restructure debt without total liquidation. But qualification requires that the majority of household income come directly from farming. Families relying on off-farm jobs to keep their operations alive inadvertently disqualify themselves from the one legal protection designed to save them. Chapter 7, complete liquidation and permanent closure, becomes the only option left. Mid-size commercial farms absorb the worst damage of all, caught in a squeeze with no exits, generating between $350,000 and $999,000 in gross income. These operations carry the overhead of expensive machinery and massive operating loans, without the off-farm safety net protecting small farms, or the sheer scale that dilutes fixed costs for the largest enterprises. Only 39% of mid-size farms earned a low-risk classification, even during 2022. And in 2026, these are the operations burning through working capital fastest, facing impossible choices about selling land that families have held for generations. The geographic epicenters, 315, Chapter 12 filings landed across federal courts in 2025. A 46% year-over-year increase concentrated almost entirely in 2 regions. The Midwest counted 121 cases, up 70%, while the Southeast recorded 105, up 69%. 33 of those filings came from Arkansas alone, the highest total for any state and the worst number recorded there in the 21st century. Rice drove the destruction, costing $1,336 per acre to produce in 2026, the most expensive principal crop in the country. And Delta rice farmers continue to lose over $200 per acre, even after federal disaster assistance. Georgia posted 27 filings, a 145% increase, tied heavily to peanut and cotton. Across 29 years, between 1995 and 2023, peanut operations posted a profit in only 5 of those years, averaging a net loss of $57 per acre annually through the entire span. Across the heartland, the numbers hit even harder. Iowa filed 18 cases, a 220% increase. Wisconsin filed 16, up 700%. Minnesota posted 13, up 300%. Missouri 16, up 167%. These states collectively feed the nation, and they are shedding family farms at a rate that has not been seen since the worst stretches of the 1980s. Why land values refuse to fall? 54%. That is the share of all cropland returns over the past decade that came strictly from appreciation, the land getting more expensive, rather than from rents generated by actual farming. The national rent-to-value ratio has collapsed to an all-time low of 2.8%, which sits below the 4% yield on a risk-free 10-year Treasury bond. A cap rate of 2.8% translates to a price-to-earnings ratio of 35.7, putting American farmland in the same valuation territory as high-growth technology stocks. 3 forces keep this paradox intact. Nearly 40% of all U.S. farmland is rented, and 80% of that rented acreage belongs to non-operator landlords, investors, and institutions that own the dirt without farming it. Firms like Nuveen, Ceres Partners, and Hancock have assembled multi-billion-dollar portfolios, and only 1 to 2% of farmland changes hands in any given year, which creates artificial scarcity that drives clearing prices upward regardless of crop profitability. Low aggregate leverage provides the second support, A 13.74% debt-to-asset ratio means creditors cannot force mass liquidations, which allows farmers to absorb years of negative cash flow without selling. What that also means is that credit decisions increasingly rest on collateral valuations rather than operating cash flow, exactly the pattern that preceded the collapse of the 1980s. Federal intervention supplies the third and most powerful prop. The One Big Beautiful Bill Act projects $1.4 trillion in farm and nutrition spending over 10 years. Reference prices jumped 10 to 21%. Corn raised to $4.10 per bushel, soybeans to $10, wheat to $6.35, and 30 million new base acres created by the law capitalized billions in future federal outlays directly into private land values. Geographic distortions embedded in that law determine which farms survive. CBO projections show peanut base acres receiving $279.99 per acre through 2031, rice at $233, but corn at just $39, and soybeans at a mere $19 per acre. Survival in 2026 depends not on how well a farmer grows crops, but on where those crops happen to sit and what commodity the family historically planted. The ripple effect. Farm financial stress does not stop at the property line. It cascades through every institution in rural America. Community banks, often the only financial institution in an entire county, hold 70% of all commercial agricultural lending and absorbed 75% of the $15 billion increase in farm loans during 2024. The largest national banks carrying portfolios over $1 billion picked up just 10% of that growth, which concentrated the entire credit risk of this downturn in the smallest, most vulnerable financial institutions in the country. Delinquencies crept to 1.2% by mid-2025. And Federal Reserve surveys confirmed a surge of desperate loan renewal requests from producers who could not clear their operating lines after harvest. Equipment demand collapsed alongside farm cash flow. Tractor and combine sales fell to 16,000 units in August 2025, badly underperforming the 5-year average of over 20,000. John Deere initiated large-scale layoffs at production facilities across Iowa and Illinois, transferring the agricultural recession directly into the manufacturing labor pool. Lexington, Nebraska offers the starkest example of what happens when the damage reaches processing. The Tyson Foods beef plant, scheduled for permanent closure, eliminates 3,212 direct positions, and the multiplier effect triggers an additional 3,791 job losses across support sectors, 7,003 total jobs statewide. State income tax revenues drop $23.2 million annually. Dawson County loses $2.8 million in local sales tax. And the grocery stores, gas stations, and schools that depend on those paychecks begin to close, replicating the hollowing out that scarred the Midwest in the worst years of the farm crisis 4 decades ago. The ghost of the 80s. Every aspect of that earlier crisis rhymes with what is unfolding now: an inflation-fueled land boom, record commodity prices, a flood of cheap credit, followed by aggressive Federal Reserve rate hikes designed to crush national inflation. Between 1980 and 1987, the average real value of U.S. farmland dropped 29%, with Minnesota falling nearly 40% and Jackson County cratering by 54%. The sector debt-to-asset ratio surged past 20%, and lenders calling in under-collateralized loans triggered mass insolvency across the heartland. What the 80s taught is that the damage arrives on a delay. Farm income collapsed starting in 1980, yet only a single agricultural bank failed nationwide in 1981. By 1985, 62 agricultural banks failed in a single year, accounting for more than half of all U.S. bank failures that year. And extraordinarily high failure rates persisted through 1987. A rigid 3 to 5 year lag separated the initial income shock from the breakdown of rural financial institutions. Mapping that lag onto today's timeline, the income shock landed between 2022 and 2024, when net farm income dropped 23%. Maximum contraction in rural retail and equipment demand should hit in late 2025 and 2026, which matches exactly what the data already shows: and the apex of stress for community banks should materialize between late 2026 and 2028 if non-performing operating loans are not cleared from their books. One difference separates this crisis from the 80s. Land values have not collapsed. The debt-to-asset ratio anchors at 13.75% versus the catastrophic 20% of the 1980s. Economists describe the current situation as a severe liquidity and working capital crisis, rather than a solvency crisis. But that entire defense rests on land values holding. A modest correction wipes it away. The threat nobody is watching. GLP-1 receptor agonist medications, the weight loss drugs that swept through the pharmaceutical market, are starting to alter food consumption at a scale that agricultural planners never anticipated. 40 million people worldwide could be using these medications within the next decade, and clinical data shows users cutting monthly food spending by roughly $53, which translates to a 5 to 8% drop in total grocery purchases within 6 months of starting treatment. Beef, pork, and ultra-processed food categories absorb the deepest cuts. If just 10% of overweight adults and 20% of obese adults in the United States adopt these drugs, aggregate national caloric consumption drops by 3%, equivalent to 20 billion fewer calories consumed every single day. Producing 1 pound of beef requires approximately 10 pounds of feed grain, which means any contraction in livestock herds multiplies exponentially through the demand chain for corn and soybean meal, potentially degrading the very crop revenues that underpin prime Corn Belt land valuations. The road ahead. Stress testing reveals how little margin remains before everything breaks. A 10 to 15% negative variance in yield or price is enough to push a mid-size farm's debt service coverage ratio below 1.0, meaning the operation generates less cash than it owes. Under a severe scenario combining a 20% yield decline with a 15% price drop and a 200 basis point interest rate hike, the modified Altman Z double prime score for a mid-size row crop operation crashes to 0.82, deep in the distress zone and highly predictive of bankruptcy within 12 to 24 months. 72% of agricultural economists expect 2026 to accelerate industry consolidation as weak, leveraged operations get absorbed by larger entities or institutional investors. Farmers face suicide rates 3.5 times higher than the national average, according to the CDC. And the Purdue Ag Economy Barometer, which tracks producer sentiment, has collapsed to its lowest reading since the 2016 downturn. $4.5 trillion in assets, and the people who actually grow the food cannot make the math work. Farmland retains its value because of what it represents, a finite, irreplaceable resource in an uncertain world. But farming keeps losing money because of what it costs: seed, fertilizer, diesel, labor, interest, and rent that never come down, no matter how far crop prices fall. Depressed income through 2027 will eventually pull land values toward the gravitational center of economic reality, and a simultaneous collapse in both operational earnings and asset valuations would trigger a compounding, non-linear crash, transitioning the agricultural economy from tight cash flows to structural, widespread insolvency. The paradox cannot hold forever. Something has to give. And when it does, the cost will not land only on the farmers. It will hit every community bank, every equipment dealer, every processing plant, and every consumer connected to the most fundamental industry on Earth.